What is a dividend and how do they work? Understanding dividends is critical for investors who want to obtain consistent income from their investments. So what exactly is a dividend and how should it impact your investment strategy? A dividend is essentially a quarterly distribution of earnings from a business to its shareholders. It is a bonus for individuals who continue to own the company's stock. It is also an effective financial management tool for businesses. Dividend payments are critical for retirees who require regular income from their investments. Similarly, many investors rely on dividends to cover some costs, e.g., the quarterly payment of school fees. Others see it as a type of passive income essential to financial independence. In this video, we will look more closely at what a dividend is and how understanding dividends might affect your investment strategy. 1. What is a dividend? An introduction and explanation. As said before, a dividend is a percentage of a company's earnings that it distributes to its present shareholders. The dividend payout (DPO) ratio is the dividend paid by a firm as a percentage of its net income, earnings. For example, if Company A earned $1 million in the first quarter of 2022 and paid a dividend of $400,000, its dividend payout ratio is 40%. Companies, on the other hand, disclose dividend payments to the public on a per-share basis. Coca-Cola, for example, announced a dividend payment of $0.44 per share for the second quarter of 2022. This is known as dividend per share (DPS). So, if Mr. A owns 1,000 Coca-Cola shares, he can expect a $440 dividend. Based on this, a company's DPO ratio is its DPS divided by its EPS, earnings per share. It might be measured quarterly or annually. But you may wonder, what is a good dividend per share? One method is to simply compare the DPS to that of another company. Coca-Cola's $0.44 DPS, for example, will outperform another company's $0.24 DPS. However, DPS is not even the greatest method for determining the value of a company's dividend payout to an investor. The dividend yield, which evaluates the dividend payout in proportion to the stock price, is a better metric. Dividend yield is just the DPS divided by the share price multiplied by 100. With Coca-Cola now trading at $64.74, a $0.44 dividend payout per share results in a dividend yield of 0.68%. Dividend yields, on the other hand, are frequently calculated as an annual figure rather than a quarterly figure. Coca-Cola's DPS in 2022 was $1.76. At the present share price, that equates to a dividend yield of 2.72%, which is better than the S&P 500's 2% average dividend yield. This is the figure to compare to previous years, comparable companies, and the industry average. It is also the figure used by fund managers to pick the dividend equities that will be included in a dividend fund. More on that later. Dividends are one way that businesses choose to reward their shareholders, though companies may have many reasons for paying dividends. And it represents a chance for shareholders to generate income from their investments in a company's stock. Keep in mind that not all businesses pay dividends. Nevertheless, for those that do, dividends might be paid in the following ways. Cash dividend. Dividends are paid as cash payments into shareholders' brokerage accounts, which they can then withdraw into their bank accounts. Stock dividend is a dividend that is received in the form of new company shares. Instead of, say, $2 per share, a firm can pay a dividend of 0.005 shares for every one share. DRIPs, dividend reinvestment plans/programs. A DRIP allows you to reinvest your cash dividends into the company's equity automatically. Instead of being deposited into your brokerage account, the dividend is automatically used to acquire additional shares at the current market price, which is often lower immediately after dividend payment. Special dividends. For a variety of reasons, certain non-dividend paying firms may opt to pay dividends on an irregular basis. More on this below. Such dividends can still be paid in cash, shares, or through a DRIP. Fixed dividend. Companies modify their DPS based on their earnings and financial management objectives. The dividend on preferred stocks, which combine components of a stock and a bond, is fixed until the maturity date. 2. Why do companies pay dividends and how do they affect investors? Apart from the aim to reward their shareholders, why do firms pay dividends? First, Businesses might pay dividends to reassure investors about their stability and profitability. If a company consistently pays a dividend and even increases its DPS, it sends a signal to its shareholders that it is doing well. Such signals will encourage current shareholders to keep their shares or possibly acquire more in order to attract new shareholders. This is also why companies that already pay dividends find it difficult to discontinue. Even if the corporation has other legitimate reasons for stopping or delaying dividend payments, doing so may send a warning that the company is in trouble. However, there is no guarantee that a firm that pays monthly dividends will continue to do so in the future because they are not required by law to do so. Second, corporations can pay dividends if they lack a better channel/outlet for their earnings. That is, corporations pay dividends when they do not have a better way to invest their earnings. This is especially true for businesses at the mature stage of their life cycle. At that point, there is little room for expansion, and earnings are better spent rewarding shareholders. Companies that pay special dividends or regular dividends do so primarily for the second reason. There is no other way to invest excess funds. When these two factors are considered together, it is no surprise that 400 of the 500 stocks in the S&P 500 index, an index that measures the largest 500 U.S. companies, pay regular dividends, according to Dividend.com, a website dedicated to all things dividends. Furthermore, businesses in the basic materials, consumer goods, financial, healthcare, and industrial sectors are well known for paying constant, consistent, and growing dividends. As mentioned in the beginning of the video, dividend-paying firms are frequently appealing to retirees and other investors seeking consistent passive income. Given the foregoing, why do some corporations choose not to pay a dividend? Many companies in their early development or introduction stages of their life cycle prefer not to pay dividends since they have numerous opportunities to invest their earnings for growth. Instead, they prefer to invest in these prospects in order to increase their share price over time. These companies are frequently appealing to growth investors that want long-term share price increase above regular income from their investments. Alphabet, Amazon, and Meta Platforms Incorporated are examples of high-quality dividend-free growth equities. 3. How do businesses pay dividends? How will a corporation pay a dividend, often or infrequently, if it has decided to do so? The dividend payout process involves 4 key dates. Date of announcement or declaration. This is the date on which the corporation announces the payment of dividends for a given quarter. The DPS, the record date, and the payment date are all included in the notice. Ex-dividend date. The day on which a company's share purchase is no longer subject to dividend payment for that quarter. That is, anyone who purchases shares on or after the ex-div date will not be eligible for a dividend. The stock exchange, not the corporation, determines the ex-dividend date. Record date. Only individuals who are recognized as shareholders by the record date or date of record are eligible for dividend payment. The record date is the same as the ex-div date, except that the firm determines the former while the stock exchange determines the latter. Because equities purchased on the ex-div date may require some time to settle to meet the record date, the ex-div date is earlier than the record date. Payment date. This is the date on which dividends are paid in cash, stocks, drips, or fixed dividends. 4. Dividend investing 101. What you need to know. After explaining what a dividend is, let's look at dividend investing as an investment strategy. Dividend stocks and mutual funds. The first step is to investigate the various ways to invest in dividend-paying firms. A dividend stock is a stock that pays out dividends on a regular basis. It should be noted that a company's stock that pays dividends only occasionally does not qualify as a dividend stock. The main distinction is the regular and constant distribution of dividends. Target Corp (TGT), JPMorgan Chase & Co. (JPM), ExxonMobil (XOM), and PepsiCo Inc. are all popular dividend stocks (PEP). There are also ETFs, mutual funds, and index funds that mix a variety of dividend equities into a single portfolio. These can be a basket of dividend stocks in the U.S. market, like Vanguard High Dividend Yield Index ETF, the global market, such as Vanguard International High Dividend Yield ETF, emerging markets, iShares Emerging Markets Dividend ETF, for example, or developed markets, such as Global X MSCI Super Dividender, EAFE ETF. They can also be a collection of dividend stocks with certain qualities. Dividend aristocrats, for example, are a type of dividend stock. These are dividend stocks that have regularly increased dividends over the last 25 years. Be a member of the S&P 500 index. Have a market capitalization more than $3 billion. Optional for some investors. A dividend fund that solely invests in dividend aristocrats is ProShares S&P 500 or Dividend Aristocrats ETF. Some funds also filter dividend companies based on DPS and dividend yield and only include those that fulfill certain requirements, for example, A-Shares Select Dividend ETF, while others only include dividend stocks that also meet particular value or growth criteria, like Vanguard High Dividend Yield Index ETF or Vanguard Dividend Appreciation ETF. Dividend funds reduce risk for investors by combining individual stocks into a diversified portfolio. They are also useful for investors who are unable to research and select dividend stocks on their own. What exactly is dividend investing? Dividend investing is an investment approach in which dividend stocks and dividend funds are prioritized. The purpose of dividend investing is to earn regular, stable, and growing dividend payments in terms of DPS or dividend yield. To summarize, dividend investment is frequently preferred by retirees and other shareholders who require consistent passive income to satisfy specific expenses or achieve financial independence. Dividend investing is frequently compared with growth investing, in which investors choose growth stocks and funds that can give the best long-term price appreciation. Growth investing is preferred by investors who do not worry about earning income from their investments. However, some may view dividend payments as indication of a company's stability. It should be noted, however, that this differentiation is not absolute. Many growth firms pay dividends, and many dividend companies outperform growth stocks in terms of growth. Furthermore, as previously stated, the Vanguard High Dividend Yield Index ETF includes dividend stocks that are also value stocks, and the Vanguard Dividend Appreciation ETF includes dividend firms that are also growth stocks. Should you use a dividend strategy? A dividend investing plan is ideal if you demand regular and consistent income from your investments. However, an absolute dividend investment approach may have the disadvantage of low long-term share price growth. Many dividend stocks will not have above-average returns because they paid dividends with money that could be used to build the firm. Furthermore, there is no guarantee that a corporation that is now paying a dividend will continue to do so. However, you can mitigate the effects of these disadvantages by selecting dividend companies with higher-than-average returns or dividend ETFs with growth or value characteristics. So, if you do not want a regular payment and your primary goal is to maximize growth, a growth investment plan is preferable. That's all, guys. Thank you for watching. Please leave your opinions in the comments section below. Like, share, and subscribe to our channel for more amazing videos.